Have you heard that 90% of beginner investors fail? The reason isn't the market. It's a single mistake that most people don't even realize they're making. Today, I'm revealing the one mistake that destroys 9 out of 10 novice investors, and how you can avoid it to build lasting wealth. I've analyzed the behaviors of successful investors and failures, and this error is the most common one I've seen. By the end of this video, you'll know exactly what to do differently. Statistics show that most beginners stumble badly, and it's not about how much money they invest, but how they invest. Whether it's late starts, buying trend stocks, or panicking at market dips, these behaviors wipe out portfolios. Matt Menendez listed starting too late, investing in things you don't understand, and selling out of panic as top mistakes made by 90% of investors. Investopedia and Mintos reinforce emotional decisions, chasing returns, failing to diversify. These errors frequently sink beginners. But there's one underlying catalyst driving all of them. The real culprit? Diving in without a structured plan or discipline. Without defined goals, risk limits, and a strategy, investors are left reacting, chasing hot stocks, jumping ship at the first dip, changing tactics mid-game. Barry Ritholtz calls this an unforced error. Panicking or chasing returns destroys compounding power. Whether it's buying a trendy stock or selling in fear, these unpredictable behaviors are not market problems. They're behavioral mistakes that even billionaires must consciously avoid. How this mistake manifests. 4 key behaviors. 1. Chasing trendy stocks without understanding them. Investors get drawn to so-called 10x stocks, or the next big thing, without checking fundamentals or evaluating risk. Without a plan or conviction, they buy high and risk losing it all when sentiment shifts. Action. Only invest in companies or funds you understand. If it's the next big thing, investigate. Otherwise, let it pass. Benefit. You invest with clarity, not fear of missing out. FOMO. Panic selling at market. Dips. Market fluctuations are normal, but beginners often panic sell during downturns and lock in losses. Ritholtz warns, reacting to news-driven dips is an unforced error that destroys compounding. Action. Set a strategy with defined stop-loss levels, e.g., I'm okay with a 10% drop, and hold if fundamentals don't change. Benefit. You let compounding work, not fear. Trying to time the market. Beginners often try to buy low, sell high, but timing the market consistently is nearly impossible. Lack of discipline shows in high turnover, high fees, and missed compounding opportunities. Action. Pick a strategy, e.g., index funds, and stick to it. Use dollar-cost averaging to invest regularly and automatically. Benefit. You avoid emotional decisions and benefit from disciplined investing. Lack of diversification. Many put all their savings into one hot opportunity, often a penny stock or a single sector. This exposes them to huge risk if it fails. Charles Stanley advises diversifying across stocks, bonds, and assets to manage risk. Action. Choose a simple, diversified strategy, like ETFs covering different sectors and geographies. Benefit. When one asset dips, others hold you up, and you sleep better at night. So here's the bottom line. Without a clear plan and discipline, investors fall victim to FOMO, panic, impulsive decisions, and concentration risk, destroying their chances at compounding and long-term growth. Action. Plan. Define your goals and risk tolerances. Stick to a simple, diversified strategy. Invest regularly with dollar-cost averaging. Set stop-loss limits and resist panic. Educate yourself constantly. Avoid hype. Remember, success in investing isn't about getting rich quick. It's about having a plan and sticking to it. Avoiding that single destructive mistake, lack of discipline and structure, can take you from beginner to long-term investor. If you found value here, like the video, subscribe, and hit the bell. Your future self will thank you for taking control today. See you in the next one.